Mr. Kevin Gracyalny, thank
Mike.
you for joining us on the Million Dollar Dads training call today. For those of you that don't know, Kevin is kind of in my neck of the woods here in Wisconsin. Kevin has built a pretty incredible portfolio of real estate over the past, 5 or 6 years? Have you been at this game?
Yeah, 6 years.
And primarily almost everything in the apartment world. So him and I are kind of in the same markets, but we're going after a couple different things. So it's pretty incredible. Just to what I'm excited about for today is just to hear a little bit of Kevin's story. He's young too, guys. He's not old like the rest of us. So I'm excited to get into his story. He has a lot of ties to another group of ours, Front Row Dads, because he has a Cutco background. So he knows a lot of those guys, the OGs of Cutco. Really exciting. And it's interesting because there are guys, I don't know, for you that are listening that may not be familiar with Cutco, they sell the best knife in the world. Let's just call it what it is, right? And Cutco Vector Marketing has produced some straight ballers. And there are just, guys like that we know, Hal Elrod, Justin Donald, John Vroman, Tim Nikolaev. There's a lot of guys, the OGs that I would say Cutco, but that trickles down as well, right? That culture kind of works its way into everybody who comes into their organization. And Kevin maybe isn't a 10-year Cutco rep, but I know that he took a lot of what he learned in Cutco and translated that to real estate. So that was a long-winded intro, Kev, but I appreciate you being here, man.
Thank you for the invitation. It's an honor to be here.
So I want to paint the picture of think of this through the lens of like where you were, right? Rewind the clock pre anything real estate, right? What was your situation like? And then kind of like what prompted you to even look at real estate as a vehicle? Rewind the clock and give us a little bit of context and tell us a little bit about your origin story.
So pre-real estate, yeah, I sold Cutco, started freshman year in college and sold for 5 years, um and that was quite an incredible experience. Even besides the financial, income, the culture is very hungry for growth and focus, and you learn about human behavior and cause and effect and how to kind of work yourself. Um, so I can sometimes when I say "oh," I can hear the Wisconsin in the "oh." So probably anyone who's not in Wisconsin like us, Mike, is like, "Oh,
I
yep,
thought you were Canadian for a second.
yeah." um, so yeah, I sold Cutco for 5 years, and like a leg of that business is going to fairs and events, and you're selling at these events. So I remember in May of 2017, I I had $17,000 and bought my first rental duplex, and then took the other remaining $8,000, and I started buying and selling products. And still to this day, I actually just packed up this morning. I'm going to another show. So that business, I buy products and import some and go around to these shows and sell. And that kind of kicks off cash to invest. Um, and when I think back, it's kind of funny how like you get used to what's in your proximity, like it just becomes normal. Where like back in the day, doing trade. So for 2017, May of 2017, I started buying and selling products. And for three, well, yeah, about 3 years, it was just, and I still reinvest all the profit. All the profit I make gets reinvested. Um, and there it was taking, whatever money, whatever profit there is, reinvesting it into inventory, buying more of it to get your costs down, um, and just kept reinvesting. And like it was a lot of living, making as much as possible and living on as little as possible. Like those first couple of years, I probably lived on $20,000 and $25,000 respectively, and slept in my van instead of paying for hotels. And you know, for food, instead cold cut sandwiches, the price per meal goes up. So there's a lot of PB&J, granola bars, apples, bananas, like the lowest price per meal. And, don't buy clothes, don't buy a new car. It was just very frugal, you know.
Yeah. What do you see as so you're I mean that gives I think these guys a great perspective of kind of where you were, and then to just hear the number of, a $16 million portfolio thereafter, right? So there a lot of the guys that are listening to this that are on our call that will be in the Q&A, their ground zero where they're starting at today isn't to that extreme, right? What is it about apartments that caught your eye, and why might an apartment, multifamily in some general be possibly a good option? Like if you were giving a sales pitch right now to these guys about why to get into apartments, what are some of the benefits of that tactically? And why did you choose it?
Okay, real estate in particular, the most attractive thing to me is the loan pay down, where you can, you do 20% down, you have 4 times that in debt. And so you take whatever that starting capital is and you pay off that loan, and in 15 years, 20, 25 years, 30 years, in 20 years, you're taking $20,000 and you're turning it into 100. And that does not account for any appreciation, any increase in values, any cash flow. It ignores all of that. And just on the loan pay down, it's a pretty healthy return just doing that. But then there is also cash flow. There is also appreciation. I mean, just looking at the last couple of years, one of apartments specifically, and to put it in context, like the biggest project I bought was last December, is 35 unit. And I've got some 12s and some like, smaller mid multifamily, and then a lot of duplexes and 4 units, a lot of small multis. So it's kind of scattered across all that. But what happens is when a unit's rented out, like it's an average return. Sometimes the unit's going to be vacant, sometimes you have to replace a roof. And so having more units diversifies the income stream. So if a specific unit goes vacant or multiple units go vacant, if you on average set on 5% vacancy, when you have a house, it's just sitting vacant. And if you have other money there, then you can eat it and it's just fine. But having more units allows to kind of diversify vacancy risk and repairs, and it kind of solidifies the revenue stream because one unit's underperforming and then you have others to make up for it. And you don't know before going into these which deals end up performing the best. You just kind of you buy and you find out, and you underwrite and you kind of prepare and have an expectation. But apartments today, I mean, we all know there's a shortage of housing, so it helps insulate against rents decreasing and values declining. Even, I mean, shoot, we're in Wisconsin. When interest rates went up, and I don't know where everyone else is on the call here, but we saw values still increase and tick
Increasing.
up over the last year.
Yeah.
And I was wrong. I thought we were going to see a little bit of price drop, but supply continued to shrink, even with interest rates higher, cost of money being higher. It's insulated, especially where we're at today in this environment.
Yeah. You mentioned underwriting. It leads me to a two-part question from a tactical standpoint. Again, is it myth that number one, financing an apartment complex is more complex and harder? I think that's one of the things that a lot of people will look at is be like, oh, it's so much easier to go buy a house. It's so much easier to even just buy a duplex, right? Because even a duplex is kind of multi-family. It's 2 units. It's more than one. But the general the general like thought about a duplex is it's still a house. So what's the financing? Is it actually harder to finance one of these properties? And then you mentioned underwriting. Like, what does underwriting mean at a very basic level of somebody looking to get in it? And how do you underwrite something?
Yeah. Financing is easier on commercial financing. Buying an apartment, it's easier than buying a house.
Hmm.
Um,
Why
so
is that? Break that down for a second. Why is it easier?
I think banks just want that collateral. They want that because they know there's a lot of demand. A house, and financing is available for both, but the when a bank does their underwriting, from my experience buying a house, I remember buying a 20 unit in De Pere, a good area. And the financing to get from the bank was easier than getting this place that I'm in right now. Where when they're underwriting you personally, when a bank is giving a loan to someone for a personal residence, it's different. It's a different department than commercial financing. So what they look at, the things they're looking at are different. So for a house, they're looking at your debt to income, your credit score, and like I'm self-employed. I imagine many people here are self-employed. And so tax returns can not show as well as what you're doing. Um, and it's less reliable than a W-2 guaranteed income. So banks can look at it a little harder. Um, but the things that they're digging in on, um, personally, it's like people have described it as a colonoscopy, a little more of a colonoscopy for a personal loan. But then commercial, they're just looking at the debt, where the lease is, what are you going to do to it? How's it performing now? What are you going to do? And if they like the collateral, then, banks like apartments because they know they can turn around and sell it. It gives them an income stream if they have to take the loan back.
Yeah.
Um, so their risk is mitigated a little more with an apartment, I think. Or that,
One of the things that Jason talked about, obviously, and for sure, they're lending against the income, not also of the property, not just the property itself, where, with a residential property, I'm going to do air quotes, the value changes just because your neighbor sold a house for a certain amount, right? Higher or lower. Where with apartments, it's more stable from an income producing standpoint, and you can look at the trends year over year of other apartments, and it's based on the performance in addition to what the property is worth, but mostly based on performance. Um, One of the things that I was wondering, you mentioned underwriting, I think everybody kind of has an idea of what it is. Essentially, it's what are the numbers on the property and how will it perform? And is it, my question is how do you on the front end underwrite a property so you're ensuring that the bank will be okay with it as well, right? Because you don't want to go try to buy a property, go through all the bank financing and do all the stuff, and then come to find out, oh, the bank won't lend on this. So now what do I do? So how do you go about the underwriting process? What does it have to do? Everybody's process is a little different. So if I interviewed 25 guys about how do they underwrite a deal, I'm going to get 25 different answers most likely. But how does Kevin approach it be as simplistic as you want or as complex as you want?
good. And sometimes I get long-winded, so just cut me off and reel me back in if I go off in a irrelevant direction. Um, okay, so banks tend to look at two things in commercial underwriting: the collateral and their loan to value, and in underwriting, because yes, but it's like you said, it's underwriting is your projection of the income and expenses. So you buy a building, what's the income? What are the expenses? How does that play out at the surface? So for commercial financing, if you're not living in the property, you're getting a commercial loan. So commercial a bank looks at two metrics. They look at their loan to value. So if Kevin stops paying, what do they have? How much do they have into it? And what's it worth that they can sell it for so that they don't eat a loss on it? So they're looking at the loan to value, the collateral, what's it worth, and how much debt will they give on it? And the second piece is the debt service coverage ratio, which is my main measurement for if a building is worth buying or not. So a debt service coverage ratio is pretty simple. You take your revenue, which is all the rents, coin op, pet rent, whatever. So you take all the rents, subtract out operating expenses, not the mortgage. So a unit will be vacant sometimes. You're going to have maintenance. You're going to have a property manager if you're not managing it yourself. You're going to have utilities. Depending on the building you're buying, you might have to plow the snow and cut the grass and a dumpster. So depending on what you're buying, what are the expected expenses that you're going to pay? You subtract those out. So if a building has $10,000 a month in rents, and then you have $5,000 in operating expenses, then that $5,000 left over is called the net operating income. And then the debt service coverage ratio is that net income divided by the mortgage. So if the mortgage is $4,000 and the net operating income is $5,000, that's a 1.25 debt service coverage ratio, which basically means you have 25% room for error, and the building will still support the mortgage.
Is there a certain number that cannot be below?
Banks,
like general rule of thumb?
1.2. Most of the banks I've talked to, they're about 1.2.
And when you buy that, and when you're talking about, you had a lot of different things, right? The gross rents, expenses and stuff.
And I can break those down if you want or whatever, but
yeah, I think right now we'll keep it high level, because we might break it down more in the Q&A as guys try to get deeper into it. Are you valuing on current performance? Like, what's the game there when you look at current performance based on future value? Because, I talked to a bunch of sellers in a different realm, and the seller is like, yeah, well, each unit's getting 500 a month, but it could be 850. I know for a fact. And I just haven't raised the rents. Right. It's like, okay, great. Well, oftentimes in their mind, their asking price would make sense if the rents were 850, but the rents are 500. So Mr. Seller, when you're having that conversation with somebody, how are you valuing that? Right. Because there could be a deal here potentially. Do you take that into account when you're underwriting your deals?
I look at both, because what happens is in that case, and I bought a lot of places, that's a very, very common situation, where rents are low, but the rents could be higher. But what happens is you take the cost to get there and you add that in. So yeah, maybe this 2-bedroom apartment, and we're in Green Bay, so these numbers might sound low, depending on where people are at in the country. But if a 2-bedroom can rent for 850 and it's at $500, what happens is I do a stabilized performance. So when the asset is stabilized, how does it perform? And then what's the cost to get there? So when you raise the rents from 500 to 750, 800, whatever, it's common that those renters will move out. It's a big jump, which I understand, and they may vacate. So when you have a vacant unit, what do you have to do to that box to where it's worth someone paying $850 a month to live there? So then you detail out, okay, in this unit, paint, flooring, light fixtures, update the countertops. So you put a rehab budget together and add up the total. So I go through the whole building, write out a detailed rehab estimate. And so if you're paying, and then you add it to the purchase price, because it goes into how you're going to finance the deal. Because most of the time when I buy a building, it's a construction loan. So I'll do 15 or 20% down on the total project. So if the purchase price is 500,000 or a million or whatever it is, you take that rehab budget, go through all the units, put your rehab budget together, and then add that into the total project cost. At least this is how I do it based on this loan that I'm getting. And it's 20% down on the project, which means if you have $50,000 in rehab or 100,000 in rehab, you're not paying 50 or 100,000 out of pocket. You're only paying 20% of that, but it is increasing the loan size. So you still have to cover that debt service because you have a little more expensive loan. But you're just adding it to the purchase price, and then it's a down payment on all that. So you do look at the stabilized performance, but you have to look at what's it going to cost to get there. You wrap all of those costs into that loan, and then you're kind of prepared.
One of the things you see, oh, go ahead, finish that thought. Sorry.
Oh, sorry. I was getting, because like there's different details depending on the building. Like if the stabilized rents are $800 and the current rents are 700, it's less likely that a unit will go vacant. But if it's a bigger gap, it's more likely that the unit will go vacant. And then you want to make sure, if it's a bigger gap, that budget for every single unit, you know.
And one of the things I always like to say is it's always more of an art than a science, right? You can't say this is the exact way to figure this out because there's always going to be metrics that come up or things that you're underwriting that are going to be different for every use case. We hear a lot. I got a couple, just 2 or 3 questions here as we finish out this portion of our podcast here. I hear a lot about no money out of my pocket, other people's money. You just mentioned I have to put 20% down on my whole project. So let's say my entire project is $1 million, right? All in, including all those expenses that you talked about, right? To increase to do a reno on the units and whatever it is, all in, it's $1 million. But I got to come out of pocket $200,000. But I know I always hear people saying that I can do this without any money out of my pocket. Is that true? Is there a way to do that? Is there a way that the bank would wrap the loan such that you don't have to come out of any money out of your pocket, but then you don't have skin in the game? So do they like that? Or what are some options there? Because if you're looking, I mean, some of these guys, right, are in different markets, not Green Bay, Wisconsin, where $1 million would get you a class F property. You know, TJ's down in Austin. He couldn't touch a 4-unit for less than $1 million. But 200 grand out of his pocket, that's a big chunk of change. So how would he approach that?
Okay. So a couple of different things. I love this question. This is one of my favorite things, especially as people are getting into real estate, because there are ways, and I can break down a few. They are pretty simple. There are ways to get into a property with no money or very little money. I've done it. I still do it. And I can break down what those mechanics are. But there's a difference between getting into a property for no money and not having any money. If someone, and I mean, and this is millionaire, you know, so people may have liquidity. If you do, great. If not, or if you have money, but it's tied up in one of your businesses or whatever, it's better to have a cash buffer because things go wrong, and it happens in real estate. Things don't always go as planned, which is normal that things don't go as planned. So you just want to be prepared for that. So if someone doesn't have savings, have cash in the bank before going in is, I would strongly believe. So there are ways to get into property with no and low money down. So besides a traditional 20% down, basically you still need to come up with the money to buy it. So commonly there are hard money lenders. It's not a bank. It's either a company or an individual that has liquidity, or they brought people together. They have money to lend. It's a higher interest rate. Typically there's points around here in Wisconsin. There's a couple of guys that'll do it at 3 points and 12% interest. A point is 1% of the loan. So if you're buying something for $1 million, 1 point is 10 grand, 3 points is 30,000, and you're paying 12% interest. So if a deal is, so that's one approach. Another approach is that you can still get a bank loan because the bank debt is cheaper. And you basically get that down payment money from someone else.
Mm-hmm.
Some lenders, and so the seller can carry a note, and it's going to depend on the bank because some banks want the person who's buying it, they want skin in the game.
Yeah.
Some banks don't care as long as their position is at 80% loan to value. So there's a guy I know locally who he lent me that 20 unit deal in De Pere. It was an $867,000 purchase price. So it was like 160,000 or so I needed. And I didn't have it at the time, but I put the building under contract because it's a really good deal. It was a big discount, really good price. So a guy lent me at a 12% interest. He lent me the 150,000 I needed to close it. The bank knew you communicate with the banks that, they understand what's going on. But a guy lent at a higher interest rate. He lent the down payment. We did the value add. We raised the rents. It was worth a lot more by the time we were done with it. And then refinanced that loan, paid him out. And then I was into this property with, it was like $26,000.
Yeah.
And
I think I think on the Q&A, we'll break that kind of, you mentioned the mechanics. I got one, we'll break that down. I got one, a little bit more in-depth question, and then a quick, like, what do you see question. As we turn away towards kind of the public facing podcast here, I want to rewind the clock back just quickly to like your first or second deal where that you remember, right? Like large enough, substantial deal. Cause you mentioned in the beginning, you said, I was making $20,000 to $25,000 a year.
Living on 20,000. Yeah.
Living on. Yeah. Living on. Okay. So you're living
I was
on
making like 200, 250, but I was living on the cheap.
Got it. So let's say taking that, but then also keeping in mind the fact of like, okay, I'm an entrepreneur and I make $200,000 a year and I write off 190, just to make sure I don't pay taxes. Mm-hmm. How can you walk us through just the high level numbers and like why did the bank even look at you like you knew what the heck you were doing on that first deal, with all those things kind of in mind, from an entrepreneur that might be listening to this?
So banks want to see income on your tax returns. So it is kind of on one side, you either pay less in taxes if you write off everything you can write off. But on the other end, depending on the loan you're getting, a bank, residential, if you're buying a home to live in or a multifamily, you're living in one unit, running out the others, a residential loan, they underwrite based on your income. So when I was getting in, I understated expenses on my tax return. I could have written off more, but I wanted to show a $40,000 income to make it possible to get a loan, an owner-occupied loan. So I chose to not write off everything I could to pay a little more in taxes, but then I could get a loan. Residential, they look at your debt to income. Commercial loans, they'll look at it, but you don't have to support the full property yourself. They'll look at the property, they'll look at the leases, they'll look at the rents. And even if, Kevin doesn't have strong enough income to pay for this $867,000 building on paper, they're looking at the, $12,000 in rents.
Got it. That makes total sense. So you kind of actually got to make that decision of, I'm going to say, play the game a little bit on the front end, because there's always going to be a little bit of, I'm giving up something here, but I'm gaining it there, and which you can't just make a snap decision. It's got to be a plan. And you knew, that your plan moving forward was to build and to continue. I know to this day, to continue to build a massive portfolio. You mentioned interest rates going up, and I'm going to end with this on the podcast portion here before we go into the member only Q&A. You mentioned as interest rates were going up, your prediction was wrong on on what was going to happen
Right.
with the market. So naturally, I'm going to ask you, where do you see the market going now? Because you were wrong before, and this is your ultimate chance to redeem yourself right here. So
It
what do you see
is.
for the
Yeah.
future of you're entrenched in multifamily. I know you do a really good job of keeping a track of the macro real estate, but where do you see multifamily going in the next 1, 5, and 10 years, maybe?
Um, long term, very bullish. I think long term the fundamentals of real estate are very strong. Um, yeah, because it's either going to be redemption or verification that my predictions are skewed. Okay,
Right. Kind of
so
like how Gary V will often play a clip back from 2010 when he was right about something. We're going to do that same thing, whether you're
right.
right or wrong. This prediction right now.
Either way. Okay, so there's different factors going on. One, we have shortage of housing, interest rates are up. The Fed has indicated that they're going to be higher for longer. They may be, I mean, they were slow to raise rates and kind of put a blanket a little bit on the economy. They may be slow to lower rates. Um, so my, it depends on the market. I'm very optimistic about us at
Hmm.
Wisconsin. Because of with higher interest rates, that's what's making it a squeeze on investors. I mean, our prices are $200,000, $300,000 for a house. Housing, I think, is very solid. And maybe there is a little bit of a dip because the cost of money is higher. The prices are still very high. So people, you're getting kind of squeezed on both sides. But there's still such a shortage all over the nation and market dependent. But
Yeah.
I think that housing itself is very solid. I have very little concerns about housing. Um, and that includes small multifamily. Um, Medium multifamily, cap rates, cap rates, locally, I have not seen them go up. Product 6 units, 8 units, 12, it's still trading at very high valuations. So cap rates are still low. In us. Now, in other markets, it may be different. I don't know all the nuances of all these other markets, but
Well, I
um,
think that's one of the important things to mention as we wrap here, as you mentioned us, meaning you and I, we're in the same
right,
market, that when people think of the market, air quotes, the market, oftentimes headlines that you see, everything gets painted with this broad brush. And you really have to understand that for guys that are in Missouri, for guys that are in California, Oregon, wherever you're at in this group, Austin, Texas, the market is local to you, and you need to know what your micro market is doing. You can't make a micro decision with macro information because it's just not the same. So I think that's one of the things to keep in check, right? Prices may be coming down in some markets, but we are in a market in the Midwest where prices are continuing to rise amidst interest rates continuing to increase, right? So I think that's a really, really important point that you have there. I want to shift us into our Q&A so that we have enough time for our members. For those of you listening to the public portion of this podcast, thank you so much for tuning in. Kevin, what's the best way for people to connect with you? We're going to post all your stuff here on the Million Dollar Dads website, our podcast site. But what's the best way to get in touch with you? Where are you most active, and how can people learn more about you and what you have to offer?
and I'll share my contact info if anyone wants to reach out or talk or whatever. Feel welcome to. I'm Kevin Gracyalny. If you're looking me up on Facebook, Gracyalny. My phone number is 920-360-1252. And my email is Kevin at gracy.w as in water, S as in Sam. So Kevin at gracy.ws. Feel free to reach out. And I'm happy to talk shop strategy, whatever.
Yeah, well, I appreciate that, man, because as those of you listening know and can tell, Kevin can really get detailed about this, and he thinks about this differently than just only at a high level. So I think it's really awesome that you're able to dive deep on conversations like this.